Hi there, it's Bill with Smart Trades. It's December 2nd around 11:40 a.m. Pacific Time. And first off, let's take a look at the NASDAQ 100 and along with the Google chart. Um, and in the past, I've noted that Google has a tendency to lead the way for the market. And you'll note back here earlier this year, Google is below its moving average, and indeed the market eventually followed. Likewise, in late April, we had that same scenario. The market was rallying, Google was failing below its moving average, and ultimately we wound up going down rather sharply from April into May of 2010. Well, that situation is occurring right now. Unless Google can get back up above its moving average, which is around the 598 area, I would think that we are going to see another decline here in the next several days, or perhaps a week or so out. It could happen sooner. We'll see. That said, let's also take a look here at the Qs. Same pattern. One way to play this would be a breakdown of the B wave here. That's around 51.88 basis the Qs. Likewise, the spiders, same type of scenario, is to wait for the break and then short on a stop here. I think there's other more aggressive ways that I prefer to play it. That said, you have to be watching the market, obviously, to track it intraday to do so. Here is the S&P chart, basically updated somewhat from yesterday. We talked about the possibility of a divergence here and a fifth wave. I actually think that this is wave 5 of 3. In other words, we've got another leg down and another leg up before it's complete. We've exceeded the gap in the various calculations by a couple of points or so. So we shall see, but I still think that it's in a short-term topping process as long as it doesn't totally blast off. I think that the context of this top is that it's a B wave. Again, the decline back to the lows in mid-November is A. The rally back up from there is an ABC that's peaking now, and that we should have a C wave down, perhaps to about 1157. Basis the S&P cash. Here's that same chart, basically on the NASDAQ 100 hourly. You'll notice that we've almost precisely filled this gap, and so far we're holding there. Also, I'll bring your attention to the strong breadth ratios that we had in the last couple of weeks on these peaks. And as I've said before, when we get these kinds of extreme breadth ratios, the tendency is that the market is going to exceed the price high that was created when we made that peak on the breadth ratio, and indeed we've exceeded that both of those peaks. That said, now we are diverging a bit. We're right at a gap resistance. Additionally, there's a potential 5-wave up pattern. So the NASDAQ in particular is looking like it's getting very close to a short-term peak. I wouldn't necessarily just fade it here until this thing starts to roll over, but it is worth watching very carefully. The Russell 2000. This is a difficult count for a variety of reasons. Probably one of the things that puts me off about it the most is the fact that internally you can count 5 waves up within each of these legs. And even though that's the case, you're getting lots of overlaps. So basically conflicting patterns. That said, if you count this as A up to the peak around 730, then a triangle pattern from there for B, and then 5 waves up, terminating right about where we are now, with an A equals C type scenario right at a parallel trend line. Again, this market's got to roll over to confirm, but it does look like it's possibly getting close to a near-term peak. Gold, the pattern to me looks corrective off of the low in mid-November. The decline into mid-November can be counted as 5 waves down. That said, I think it probably is better counted as an A. This rally back up is a B, and that also fits pretty well with the stock market. Crude, pretty strong. I had initially thought this might be an intermediate term peak. I doubt that at this point. The strength of this rally back up indicates that there's a pretty good chance we're going to see that high exceeded. Also, the Euro FX. I had noted that we had 2 equivalent legs right to this channel. Obviously, that is no longer the case. We've broken down. I think that's bearish for the euro. What we want to see here is a corrective rally that fails, perhaps in the 134, 135, 136 area, and then I think we are going to see lower prices in the euro. That said, the pattern is not ideal. Of note here, copper is just about reaching multi-year highs created back in 2008. The trend is obviously still up. That said, I think at some point up here, you're going to at least see a correction, perhaps back down to this lower trend line. I suspect that's bearish for the stock market. When it does occur, again, it may be in the context of just a corrective decline for stocks and a corrective decline for copper, but we'll have to see how it plays out. That's it for now. Hope you're having a great week, and thank you so much for watching.